Can I request Sandeep Bhat?
Yeah, I'm there. Yeah.
Yeah, Sandeep, welcome. And happy to have you over here.
Thank
We'll
you.
be happy to have your views on the market trends and the growth story, please.
Yeah, hi. Now, should I be doing the disclaimer is the first one that is always there. So you need to actually check out with your advisors. Um, to come to the Indigo Paints, you know, IPO, one of the biggest things which you would see is that it's one of the fastest growing companies in the paint sector with a 41.9 or nearly 42% CAGR between 2010 and 2019. But if you look at the size of the company, it is one-fourth the size of the smallest company out of the other four. So if it is the fifth company in the list, it is one-fourth the size of the other companies. So the CAGR obviously will be always better in terms of revenues and other things. Um, the only advantage which they claim to have is the differentiated products leading to a greater brand recognition, and that is something which is important because I think what we are having in the current scenario is disruption and innovation. I think whoever innovates, whoever actually brings out differentiated products are the winners. That is something which will in the course of time give rise to the valuations if and when Indigo is listed. Then of course the brand building exercise which Indigo has, it really doesn't have one right now, but once it gets listed, once they start advertising, the brand will be created. And again, it depends on how they create the brand, whether it is again like for example the geo aspect, they whether they disrupt and make out a brand for themselves is to be seen. Uh, the important aspect which they have is they have a penetration of 27 states, but to the extent they are in tier 3 and tier 4 cities rather than tier 1 and tier 2. So though they are in 27 states, that's one thing to be considered. uh, they claim that they are strategically located in terms of raw materials. So they have the advantage of actually proximity to the raw material so that the production is not disrupted. To come to the weaknesses, and there are quite a few, and I've said, please see the DRHP starting page 23 because there's a whole list of more than 20 risks involved, and some of them I would say is they do not have a long-term agreement with suppliers for raw material. So if there is any disruption in raw material supplies, their production is going to be impacted. The second thing is in terms of external transport, they are not tied up. So, they have to depend upon third-party um, distributors in terms of their logistics. Most important point, contingent liabilities to the tune of 31.5 crores. And if you look at it, it is there in the FY20. It was not there in the previous year. So I'm not sure on why it was not. Has it come to light only now that they are going in for a public issue? I'm not too sure of that. But there is a VAT liability amounting to 30.11 crores. And there are other things which are material in nature in terms of litigations also. So you need to have a closer look at those. Most importantly, whether it is Asian Paints, whether it is any other paint company, oil is the major input for all these companies. The price of oil will determine how the industry will grow or degrow going forward in terms of prices and in terms of profitability. So from that angle, I will come to it later because I'm going to take oil as well as the other things as a separate on technical analysis. So we'll come to that later. The next slide, Sandeep. In the opportunities, I think as I said, disruptive, innovative products, if they have it, great. And how they come to a situation where they are going to actually factor in and win over the tier 1, tier 2 cities is something which is going to be very, very important. Those are important opportunities. Those are great opportunities actually, because if their products are good, their quality is good, they can be a winner. Threats, as I said, oil is a major threat. In their report itself, in the DRHP which they have filed, the next clause on threats is what is mentioned. Floods in Kerala. Now, 46% of their production arises out of their manufacturing facility in the state of Kerala. And there were 2 disruptions over the last couple of years because of the rains, the flooding, and Kerala was also impacted in a big way by way of COVID-19. So from that angle, this is something which you need to be looking at, because disruption will take place, or should we say, will it take place, is a question mark going forward in the next few years. So from the point of view of how we look at it in terms of the valuation, um, it's priced at around 1500 to 1600. Now, the lowest of the paints companies are quoted around 41 PE. Now, these guys' profitability is around 41 crores, 42 crores, giving them something like a ratio of the price should be around 1800 to 2000. But then contingent liability is a factor which you should consider. Will it be an important aspect? Secondly, the size itself compared to the fourth best competitor is something which needs to be looked at. If they are able to grow consistently, it's quite possible they grow. But I would have a cautious approach in terms of the price of 1500 to 1600, given the market conditions prevailing currently, with oil prices being a factor which might impact them. Manoj, anything to add from on that?
Sure, Sandeep, very nice points you mentioned. Now, Indigo Paints claim it is the fastest growing paint company, and in their roadshows, they have been talking about high growth in the last couple of years. But we should always keep in mind the leader and the top 3 are very dominant. You cannot undermine the leader. Whether the claims are true or not, management can claim. Ultimately, it is a vigilant investor who will decide. That is it. And the weak points are, point is, it's an entrepreneurial management. They have a fire in the belly. They are doing a lot of wonderful work. But it's a very competitive market. There are discount wars going on. The company has mentioned about also high level of discounts. So one can do discounting war for a limited period. It happened in the FMCG sector, Colgate and Hindustan Lever, when Pepsodent was launched. So the Hindustan Lever was increasing market share, Colgate was coming down. It took time. Ultimately, the leader got high market share back, and both were strong companies with deep pockets. Here also the top 3 leaders, particularly Asian Paints, and ExxonMobil is also there. Berger is there. They have deeper pockets. So competition is severe. Ultimately, they will grow. Whether the market share is sustainable, whether the growth rate is sustainable, are key issues the investor has to decide. Today is a momentum market. So prices, high prices are determined by the market multiple. So it can maybe sell based on the buzz in the market, but we have to see whether the sustainability is there and what are key takeaways and what is left on the table for long-term investors. And short-term investors also don't lose money, because management should leave things on a table. And we all know, for people who have done deep dive in the RHP, the private equity investor is selling. Not only they are selling their part of their stake, they are selling a large stake. Why they are selling? People claim always the private equity fund need an exit, they need a listing. Fine, you need listing, but they are selling a large chunk. And so who makes more money? The private equity investor taking an exit makes more money. And if the growth rate in the past sustains what they talk about for next 5 years, then of course we can buy it as a high growth story with whatever terminal value the savvy investor would give in. But if the high growth rate doesn't sustain beyond a couple of quarters, as is normally seen in most IPOs, then it's really a challenge. So the investor should decide the horizon. Anchor investors get in because they want to exit maybe after a month. It is easy money from allotments. They don't have to borrow, do leverage in the market at 50 times, 100 times, and buy high interest cost. So very good coverage, excellent insight. And now Sandeep would like to have your independent views on the deep dive in the IPO review for IRFC, which is a very large company with a AUM total asset base of over 2 lakh crores, with a kind of income which they claim is guaranteed by the government. Some basis points are there, which is there in the RHP. Would like you to cover in detail your independent perspective of what is IRFC, what business do they do, who are the promoters, what type of customers they have got, what type of borrowings they have got, and the kind of valuation from an independent perspective. As we have already shared, everybody should study the RHP in detail and also read the risk factor, particularly before investing. That applies to Indigo Paint. It applies to all the companies. And as you have mentioned, there will be a continuous ongoing IPO review series for each and every important company. So the global investor, the Indian investor, the institutional investor, the foreign investor, the retail investor, the HNI, all those people who are bidding or participating or intend to hold on or post listing can take an opportunity and based on the risk in mind, and then participate in the India growth story.
Yeah, hi. In terms of actually IRFC, it's almost a public company in terms of the shareholding stake. There's a minor stake held by other institutions, I should say, which is not more than 10% or 15%. So that really doesn't matter. But what matters here is from the point of view of being a monopolistic arm for the financing of the railways. It was set up for garnering funds for the railways. I think this was a ploy where it was very important, to do away with, the budget for the railways, which always used to be coming up year after year. So this was a ploy where a financing arm was put in place. Whatever financing needs for the railways is met through the IRFC, whether it is in terms of capex or for rolling stocks. So if you look at the presentation itself, you would see that approximately 48% of the amounts which are generated for financing is for capex projects, and the rest of it for rolling stocks. Now, what are the strengths? I think the strengths are that IRFC is neutral in terms of interest, and this is the most wonderful thing in terms of any NBFC, because when you have something where you are actually building a block, where you are actually doing a cost plus in terms of your pricing, there's a pricing of approximately 0.4% in the last 2 years over the price of the bonds which they actually go to the market and generate financing from. So IRFC goes to the market if and when required, gets the bonds. It is, it's a bundle of whether it is interest, future interest, whether it is even hedging. Um, so everything is, included in the cost of those funds. And then there is a markup of 0.4%. So the risks involved is quite less. And that's one of the reasons why I say that, it's like a annuity. This is annuity income for you. Year after year, there will be growth depending on the growth of the railways, and and they'll be issuing dividends. If you see the last, um, point on dividends, there is a clause which says, as per the CPSC capital restructuring guidelines, central public sector enterprises are required to pay a minimum annual dividend of 30% of its profits after tax or 5% of its net worth, whichever is higher. So there'll be a definite dividend generated when you actually get into these shares. So from that point of view, I think it's not a loser. It might not have a growth aspect. It'll be an annuity product. Slowly and steadily it'll grow, but it won't, give a loss on your holding. The other aspect which you should be looking at, and I don't know whether these guys are actually doing it or not, the amount of ECBs which can be actually uh, borrowed by this institution is 75 crores USD. So 75 crore USD per annum can be converted. If there is an old debt, actually should be converted into new debt, because they are already taking care of their hedging facility in terms of USD. Secondly, interest rates in the foreign markets are almost negative, and they stand to gain, and the railways will stand to gain if that's the case. So those are important aspects. And if you see the CRISIL ratings, AAA, CRISIL A1 plus, ICRA and CARE also have the same rating, whereas I would understand the ratings which are given by Moody's, um, Fitch, as well as S&P. The problem is they are more dependent on the government's rating rather than, a company rating per se. So that's where we stand. And non-performing assets, obviously nil as of 30th of September 2020. What is the weakness? It's a government enterprise. You will have problems on, bureaucratic decision making. That's something which we will have to live with. The next slide. I think the opportunities are there, and coupled with it, the negative factors also are there. The same factors will be negative for them also. The problem is, the opportunities are that intent of the railways to actually go in for privatization. So will it mean that, the government will also say all the other, whoever private sector enterprises which are there, which are coming in for the railways, need to borrow from these guys? I don't think so. I don't think that they will do so. But if they do, it is an advantage. If they don't do it, they will be competing against the best in the industry from the point of view of other NBFCs coming in, invest, or rather lending to these private players. So this is going to be very important. Then you have convert the high cost, as I have already said, convert the high cost of domestic debt to ECB borrowing. And on the right hand side, I said competition might come in terms of, the private lenders to these private players who are likely to come in for, acquiring railway assets. So this is, in short, a synopsis of what I feel is what is going to happen in terms of the IRFC IPO. it's a good issue. It's not going to be, blockbuster. It'll give you an annuity. It'll give you a return, and it's a safe investment, is what I feel. But then go to your investment advisor.
SWOTs, as we have discussed, it's a government enterprise. As of now, a PFU, PSU, possibly it is divested soon, so people get opportunity. There is a fixed return. Ultimately, it's a market competitiveness. So there should be opportunity for all the private NBFCs also to do the bidding and get a better yield. Possibly foreign enterprises may be interested. So government policies have to be more open. And talking about safety, the safety depends on how safe is the rating, sovereign rating risk. As of now, the company gets a rating which is given to the sovereign. That is because of the assurance and also zero NPA. Ultimately, market decides. Now there is a high leverage. If one sees the RHP, leverage is over 7 times. There are many NBFCs listed which are just 4 times, 5 times leverage. Capital adequacy ratio is 30%. Even then, they are getting about 4 to 5 P. And here, the earnings multiple, possibly earnings may be in the range of maybe 3 to 5. And looking at multiples historic, a certain valuation is there which has been determined by the bidders, anchor investors. There are marquee anchor investors. A list was out yesterday. Looking at a deep dive, there are the very high quality foreign investors and local investors. But anchors also, they make an expectation based on short-term price fluctuations, and they may exit after the minimum period provided by the regulator. So investors need to keep a good watch. If they get a good opportunity or a good price in the market which is fluctuating, and we have seen the VIX also rise in the next last few days, and also there are expectations the VIX may rise in the next few days. Keeping this in mind, keeping the pricing which the investment bankers claim it's very, very attractive, investors should definitely look at the IPO. And also there is opportunity in the CFO, CEO and CXO series for various companies to join in and share their views. Also pre-IPO and post-IPO. Post-IPO, they are often ready to share about the business models and future of the company from their own perspective. But what is key and most important, the perspective of the investor and all stakeholders is much, much more important. And we have to set high expectations and raise the bar for all management, including Indigo Paints and IRFC. So they meet the expectations of the investors on a sustainable basis, and they don't destroy wealth. It is very easy to have a lineup of maybe dozens of IPOs in a booming market year. But what happens later to the investors? Often, and we have seen more than 50% IPOs, often they trade at discounts post-listing. So we just hope that the IPOs being coming down in this market, whether which is booming because of stimulus or because of business optimism, ultimately markets will decide based on future inflows by foreign investors, domestic investors, mutual funds, retail investors, the Robin Hoods, the HNI. So wonderful insights, excellent IPO reviews.